Hello everyone, I am Shashank Shenoy. So today I will be explaining about transfer pricing and its basic concepts. So firstly let us look at what is transfer pricing. Transfer pricing refers to a pricing of transaction between related enterprises, that is associated enterprises. So it includes sales, loans, services, often across the borders. So why transfer pricing matters? Say for example, there is an Indian company. It develops a software for US parent company. So real market value of the software is 1 crore rupees. So value creation happens in India. What it does is, instead of directly selling that software to its US parent company, it transfers it free of cost to its Dubai subsidiary. Then the Dubai Associated Enterprises then sells to its US parent company for 1 crore rupees. So the result is there is no tax in India as sales booked is rupees 0. Still it can claim expense, that is example cost of production. Then it reports the loss and carry forward to offset the future profit. So also there is no tax in Dubai because the tax rate in Dubai is 0. So that is why the concept of transfer pricing has come. So here income is recomputed to reflect the real value and India gets rightful tax on full 1 crore rupees. Section 92, income from international transaction. So any income, expenditure, interest and allocation of cost in relation to international transaction or specified domestic transaction shall be computed having regard to arm's length price. So what is arm's length price? Arm's length price is a price at which two unrelated party would freely agree to do transaction in open market without any influence or connection between them. So another one important note is, if arm's length price reduce income or increases the loss, then transfer pricing provision won't apply. Now let us look at section 92B, that is international transaction. What is international transaction? International transaction refers to a transaction between two or more associated enterprise with at least one should be a non-resident. So it covers purchase, sale, leases, service, lending or borrowing of money. If both associated enterprises are non-resident, then transfer provision shall apply if income of one of the non-resident is taxable under Income Tax Act in India. So transaction between enterprises and unrelated person shall be deemed to be international transaction if there exists a prior agreement between associated enterprises and unrelated party. Then the terms of the transaction are determined by associated enterprises. So let us take an example. If XYZ India sells goods to ABC Limited, an unrelated UK company, but the terms were decided by its associated enterprises, that is PQ or Singapore, based on prior agreement with ABC. Even though ABC is unrelated party, the transaction is treated as international transaction due to influence of associated enterprise. Now let us look at section 92A, that is associated enterprises. So these are the criteria to classify an enterprise as associated enterprise. So first one is capital participation. If one enterprise holds directly or indirectly at least 26% of the voting power of the other enterprises, then the both enterprises will be called as associated enterprise. For example, Tata Limited holds 33% in Tata Motor and Tata Motor holds 80% in JLR. Then both Tata Motor and JLR are associated enterprises because Tata Motor holds more than 26% in JLR. So next one is common control. If the same person holds more than 26% in both the enterprises. For an example, a person holds 30% in company A and 40% in company B. Then both the company A and company B are associated enterprises. Next one is board control. If one enterprise appoint more than 50% of board of directors or one or more executive directors of the other enterprise. For example, let us say Reliance appoints 8 out of 12 directors in Jio, then both Reliance and Jio are associated enterprises. Next one is dependence on know-how. If business of one enterprise is wholly dependent on know-how, patents, trademark or technical service of other enterprise. Example, Kia Motors, which is an Indian company, depends fully on know-how of Hyundai Motors, which is South Korean company. Then both Kia Motors and Hyundai Motors are associated enterprise. Next one is substantial raw material supply. If more than 90% of the raw material required are supplied by other enterprise, then that both enterprises are considered as associated enterprise. Next one is pricing influence. If the sale price of the goods and services is influenced by other enterprise, then that both enterprises are called as associated enterprise. Then mutual interest. Where the enterprise have been declared as associated enterprise under the rules prescribed by board. Next one is loan control. If one enterprise gives a loan to other and that loan is more than 51% of the book value of total asset of the borrowing enterprise, then both the enterprise are called as associated enterprise. Next one is guarantee control. If one enterprise gives a guarantee for more than or equal to 10% of the total borrowings of the other enterprise, then that both the enterprise will be called as associated enterprise. Next one is purchase control. If more than 10% of the goods and services of the other enterprise are sold to the other and price is being influenced, then that both the enterprises are called as associated enterprise. Next one is common individual or relative control. If an individual or their relative controls both the enterprises, for example, Mr. X and his brother controls company A and company B, then both company A and company B are associated enterprise. Next one is HUF based control. If one enterprise is controlled by Hindu undivided family and the other by a member or relative of the HUF, then both the companies are considered as associated enterprise. Next one is partnership BOI interest. If one enterprise has greater than or equal to 10% participation in profit of the other enterprise, then both the enterprise are called as associated enterprise. Section 92C, that is computation of arm's length price with the help of example. Comparable uncontrolled price method. For example, if an Indian company sells steel rod to foreign subsidiary at rupees 55 per unit, if the same product is sold to unrelated party in a similar market at rupees 60 per unit, then arm's length price will be rupees 60 under this method. It won't be rupees 55. Next one is resale price method. For example, an Indian subsidiary buys mobile phone from its foreign subsidiary for rupees 15,000 and sells to third party at rupees 20,000. If standard gross margin is 25%, the arm's length price should be 15,000, that is 20,000 minus 25% of 20,000 rupees. Next one is cost plus method. Example, an Indian manufacturing company provides parts to its US affiliate at a cost of 1,000 rupees. If independent supplier charge cost plus 20%, then arm's length price is 1,200 rupees. Next one is profit split method. An Indian and method. Example, an Indian and UK company jointly develops a software and earn a total profit of 10 crore rupees. If their contribution is in the ratio 60:40, the Indian company should report 6 crore rupees and UK company should report 4 crore rupees as per this method. Next one is transaction net margin method. Example, an Indian company provides IT support services to its foreign group company and earn a net margin of 12% of operating cost. If comparable independent companies earn 10 to 13%, then the Indian company pricing is at arm's length price under this method. Next, section 92E, that is audit report of a chartered accountant. An SSC who has entered in international transaction is required to furnish a report from a chartered accountant in a form 3CEP on or before 31st October of the assessment year, which is 1 month prior to the due date of filing return of income. So the content of form 3CEP are, it includes details of international or specified domestic transaction, then method used to determine arm's length price, then certification from CA about the correctness of information. So that's all from my end. Thank you.